How do federal student loans work for college? Have you ever wondered how federal student loans can help you pay for college? Understanding the basics can make a big difference in your financial planning. Federal student loans are a type of financial aid provided by the United States Department of Education. They help cover college expenses like tuition, fees, room and board, and other related costs. To access these loans, students need to start by completing the free application for federal student aid. This application determines eligibility based on financial need and other factors. Once the application is submitted, students can find out what types of loans they qualify for. There are two main types of federal student loans for undergraduate students: direct subsidized loans and direct unsubsidized loans. Direct subsidized loans are need-based, meaning the government pays the interest while the student is enrolled at least half-time. This typically means taking 6 or more credit hours. On the other hand, direct unsubsidized loans are not based on financial need. Interest starts accruing from the moment the loan is disbursed, even if the student is still in school. Loan amounts vary based on the student's year in school and dependency status. For dependent undergraduate students, the typical annual limits range from about $5,500 to $7,500. Independent students or graduate students may have slightly higher limits. Additionally, there is a cap on the total amount a student can borrow over their college career. To receive loan funds, students must complete several steps after submitting the free application for federal student aid. They need to be admitted to an eligible degree program, maintain satisfactory academic progress, and enroll at least half-time. First-time borrowers must also complete entrance counseling to understand their responsibilities. They will then sign a master promissory note, which is a legal agreement to repay the loan. Repayment usually begins 6 months after the student graduates, drops below half-time enrollment, or leaves school. The interest rates on federal loans are fixed and can vary based on the loan type and when the loan is disbursed. For example, undergraduate direct subsidized and unsubsidized loans have interest rates around 6.39% for loans first disbursed in the 2025 to 2026 academic year. Understanding federal student loans is important for college admissions and test preparation. These loans can greatly impact a student's ability to afford college and influence their choice of institution. It is essential for students to plan their borrowing carefully. They should consider loan limits, interest rates, and repayment terms as part of their overall college financing strategy. Completing the free application for federal student aid early and accurately is key to accessing these loans and other financial aid options. Federal student loans provide a structured way for students to finance their college education. With fixed interest rates, deferred repayment options, and need-based subsidies, they play a significant role in college financial planning.